It's about a theory called the efficient market hypothesis. So let's just talk about what that means. So an efficient market, the word efficient means something that quickly responds to information. Okay. You've all seen stock prices before, right? If you think about a stock price, it's changing every second. Why is it changing every second? Because the supply and demand for that stock is constantly changing as a result of information, right? So when good news comes out, then there's a lot of demand for the stock and the price goes up. When there's bad news that comes out, there's a lot of supply for that stock, a lot of people selling it. So the price goes down. So an efficient price or an efficient market is a market price that reflects all available information. So the flip side of that would be a market that doesn't reflect all available information, or if it does so slowly, is said to be inefficient, right? Like, I'll give you another example. Let's say some good news comes out about a stock, and then you look at the stock price and it hasn't reacted yet. It hasn't gone up. That would be an inefficiency because you know that it should, right? When a stock should be priced higher or priced lower, but it isn't, that is what we call an inefficient situation, right? When something is overpriced or underpriced, this is kind of going back to what we learned last class. When something is overpriced or underpriced, that's an inefficiency. And according to the efficient market hypothesis, a market price should reflect all available information, which means it's actually impossible to consistently outperform the market. It's possible to every now and again outperform the market, but nobody should be able to consistently outperform the market and earn what we sometimes refer to as abnormal returns. Abnormal returns are returns that exceed what you should be able to do, right? If ever you see that abnormal returns, it basically just means like beating the market. Nobody should be able to earn abnormal returns consistently. Again, you could do it this year, maybe next year, but you should not be able to do it consistently. You know, everyone should kind of follow the market. That's the hypothesis. Now, within that, there are three levels because, you know, think of this as a set of beliefs, right? It's not set in stone. So different people have different beliefs when it comes to the efficiency of the market. And then they make their decisions according to that. For example, I might believe in the weak form efficient market hypothesis. That's one version of it. Whereas Elaine might believe in the semi-strong form, and Lara might believe in the strong form. We all believe in the hypothesis to a certain degree, but a little bit differently. And so you have to understand what each of these levels means. And in order to understand that, you have to understand that there's three types of information that affect a stock's price. There's what we call historical information, right? Historical prices or past trading information. These two things mean the same thing, by the way. Okay. This refers to the stock price in the past. So looking at the price yesterday, what was the stock worth yesterday? What was the stock last year? What did the stock do last month? Did it go up last month? Did it go down last month? Whenever you're looking at what the stock price has done in the past, we call that historical price information. That is the lowest form of information. And you have examples here, right? Historical prices, volumes. Volume is just like, I don't think you really need to know this, but volume is how much of that stock was traded, right? It's just old data. Okay, so we'll start with that. Now, people who believe in the weak form of the efficient market hypothesis, they believe that only this type of information is reflected in the price. So remember what the efficient market hypothesis is, that the market price reflects the available information. So the three levels basically define information differently. So if I believe in the weak form of the efficient market hypothesis, then I believe that the price you see in the market only reflects historical data. That's it. It doesn't reflect any other type of information that we'll talk about. So what does that really mean, though, right? It means that, and I'm going to have you guys write this, people who believe in this form believe that you can outperform the market, that you can earn abnormal returns, but only using public and private information. I'm going to write it here. You guys are going to write it also. Okay. People who believe in the weak form believe that you can earn abnormal returns using public and private information. Those are the other two types. We're going to talk about them. But you cannot earn abnormal returns using historical price information. That's essentially what it is. People who believe in this form think historical price information is completely useless. It doesn't give you any advantage in having it. But if you have public information and you have private information, those can be used to earn abnormal returns. Those can be used to consistently beat the market. Okay. Now, if you move to the second level, by the way, technical analysis, like the little things you see here, technical analysis is just what we call um, using historical information. If you've ever heard that term, technical analysis is when you see like people drawing lines on graphs and saying, oh, every time the price goes down by 10%, it goes up by 20%. Like any analysis of historical price information is called technical analysis. And this level of the efficient market hypothesis thinks that technical analysis is completely ineffective because of what I said here, because you cannot earn abnormal returns with historical price information. So basically, technical analysis is a big waste of time. This blank that we have here, we're going to fill it after we've talked about all the levels, by the way. So I'm going to skip it for now. Okay, that's level one. This is one of the categories that actually has the most amount of people. Like if you were to actually survey people, people who invest money, a lot of them will fall into this bucket. This is bucket number two. Public information refers to any information that is publicly available. So this includes the historical information, but it goes beyond that. Okay. It includes the historical and price information from level one. But on top of that, it includes anything new. So a company releases their quarterly earnings. That's news. Some event happens, like the war or COVID, or changes in the interest rate, or a tweet by Elon Musk, right? Anything that is publicly available falls into this category of public information. And so people who believe in the semi-strong form of the efficient market hypothesis believe that all public information, including historical prices, are already reflected in the price, meaning that even public information cannot be used to their advantage. So I would add that as another point here, okay, that under this form, you can only earn abnormal returns with private information. You cannot earn abnormal returns with public information or historical price information. So it's like a little bit more strict than the previous one, basically, right? So, and you'll see that about each one of the levels. Each one of the levels is a little bit more strict than the level before. So people who believe in this think the only way that you can truly beat the market consistently is if you had private information. Any other type of information does not give you an advantage over anybody else. And so we say that the semi-strong form actually includes the weak form. So we can fill in this first blank here. It includes the weak form. It agrees with it and takes it a step further. And then you've got the strong form, which in real life, very few people, if any, truly believe in this level. It's just to complete the theory. This is the true efficient market hypothesis that says that all information, that is past prices, public and private, is already reflected in the price. So people who believe in this level think you cannot, no matter what, consistently beat the market. Okay. You cannot earn abnormal returns consistently, I guess, consistently with any type of information. Market is completely efficient, basically. That's what they believe in. That's it. So anybody who believes in that, we'd say that they believe the market is strong form, or they believe in the strong form efficient market hypothesis. So this one too includes the previous ones because it agrees with weak form that historical information gives you no advantage. It agrees with semi-strong that public information also gives you no advantage, and it takes it a step further that private information, guys, is information that exists but is not legally available to the public. Like knowing about an acquisition before it's been announced, knowing about a new product before it's been announced, things like that. So this blank here, you can say that it includes both of them. It includes the weak form. Right? It includes the weak form and the semi-strong. And there's a picture I like to draw that some students find helpful, so we're going to do it. I want you to draw 3 circles, but actually, wait for me to do it, I guess. But one inside the other. Okay, so we're going to draw one big circle. This is the strong form. Then within it, draw another one. This is your semi-strong. You see, the strong form includes the semi-strong. The semi-strong doesn't include the strong. It's the other way around. I do this for people who forget which one includes the other. And then the weak is right in there in the middle. So if the market is strong, it's automatically semi-strong and it's automatically weak. Right? So if ever you got a question like that on the exam where it was like, what does this person believe or what is this market? And the answer is that it's strong. Well, if it's strong, it's automatically strong and it's automatically weak. Okay. That is the theory. Like that's pretty much all of it. Just understanding what is included in the price. So like the first line of each one, what type of information is reflected in the price and what type of information is not. The type of information that is not reflected in the price is what you can use to earn abnormal returns. Okay, look at the first one. You can earn abnormal returns if you have public and private information because those are not reflected in the price. So that's what you want to remember. Like you don't have to memorize every single line that I put here. You just have to know the 3 levels. In each one, what is included in the price, and for each one, what is not included in the price. You have to remember this whole like one includes the other business. And the other thing I think is important for you to understand is that you can have violations of these levels. So what you learned here were the rules. Think of them as rules. And whenever something happens, it could respect the rules or it could violate the rules. It could break the rule. So we're going to do some examples after so you can see violations. But what I want you guys to understand is if you violate a level, then you automatically will are violating any levels above it. So if you're reading a question on the exam and the question violates the weak form, then it automatically violates semi-strong and it automatically violates strong. Think of these as levels or grades, like grade 1, grade 2, grade 3. And if you fail grade 1, if you can't pass grade 1, then you absolutely cannot pass grade 2 and you absolutely cannot pass grade 3. When you fail the first level, you automatically will fail all the other levels. But when you pass a level, you automatically pass the other two, right? Like if I'm passing level 3, well, level 2 has already been passed and level 1 has already been passed. Students have a hard time remembering which is which. Like, do I violate upwards or do I don't know what the right word is, but do I pass or accept upwards? Well, remember that when you violate the levels that are higher automatically. And these are the blanks we're going to fill up here. Okay. So look, a violation of weak is also a violation of semi-strong and of strong, right? You cannot be, if you're not weak, like if you're not even weak, you cannot be semi-strong and you can't be strong. A violation of semi-strong is also a violation of strong, right? If you're told something and that is and according to the rules, that is a violation of the semi-strong form of the efficient market hypothesis, then it's also a violation of the strong form. So now how do the questions really come up? Like the one or two questions that you'll get from this chapter is usually a scenario or more of like a definition, right? So we'll do a few of each. So here, look at question 1. These are all from past exams, by the way. So the concept of a strong form efficient market implies what? Take a second, think about what we've said so far. You can put your answer in the chat. You can turn on your mic if you want. What does the strong form imply? What does that mean? Okay, Elaine says C. You guys agree with that? That the strong form says that all information is reflected in the price? I like that. That's exactly what it is. All information. Historical, public, and private. So you see, that's more of like a definition style question that if you know the rules, free marks, right? And then there's this one here. ABC Inc. just released its quarterly earnings and beat the market's expectation. The company's stock immediately increased by 10%. This is a violation of which form of the efficient market hypothesis? Now, when you answer these questions, there's the right way to think about it and the wrong way to think about it. The wrong way is this, okay? I'm going to ask you guys a question. Would you say that what kind of information would you call that? Historical price information, public information, or private information? What do you guys think? Historical, public, or private? And you can be completely wrong here. Go with what you feel, and then we'll fix it. Worst case. Lara says public. It is public. Correct. It's public. It's not private because they've been released. And it's not historical price information. This is not a stock price. This is news. So good. This is public information. This has to always be your first step. What I don't want you guys to do is say, oh, okay, public is semi-strong. So the answer is semi-strong. And let me move on to the next question. Because half the time you're going to be wrong. Because just because we have public information doesn't mean we have a violation yet. We have, right? So the next part of the question would be to ask yourselves, is this information reflected in the stock price? Yes or no? Is the information reflected in the price? Yes or no? Now, if you don't know what that means, word it differently in your heads. Has the price of the stock reacted to the information?
Yes.
It has, right? They told us that it increased by 10%. So what's going on here? Okay. There is no violation because when the information is reflected in the price, okay, there is no violation of the efficient market hypothesis. Because remember at the very beginning of class, I said an efficient price is one that does reflect the information. For there to be a violation, there has to be information that is not reflected in the price. Like if I would have said ABC Inc. just released its quarterly earnings and beat the market expectation and the stock hasn't moved yet, that would be a violation because it should move. It should have reacted to the information, but it hasn't. Then you would have a violation. So the answer is none of the above. So the point of this exercise is to show you, and we're going to do one where there is a violation so you can see the difference. But the point is to show you that you have to ask yourselves always two questions before you pick your answer. What type of information are we dealing with? That's one. And two, this is the harder one because it's not always as obvious. Is that information reflected in the price, yes or no? If it is, there's no violation. If it is not, then there is a violation, and then then you choose, the right one. So we're going to do another one. I think the next one has a violation, so you can kind of see the difference. You have developed a trading strategy of only buying stocks after they've had 3 consecutive days of decreasing prices. You believe that on the 4th day, these stocks will also have positive returns. I don't know if the word also is doing there, but anyways, we'll have positive returns. This is a violation of which form? Okay. Question number 1. What type of information are we dealing with? What type of information are we using? Are we looking at historical price information, public or private information? Think about it. Look at your strategy. What type of information is your strategy using? Historical price information, public information, or private information? Okay, I want to get into your brains here. Which which two are you stuck between? Right? If nobody's answering, you got to be stuck between two. You're stuck. Are you saying it's historical error, or is that one of the ones you're stuck between? You're saying it's historical? I agree with that. This is exactly what historical information is, guys. Historical information is you are looking at what the stock price has done in the past or has been in the past. That's all. Your strategy revolves around looking at the previous stock price, even yesterday's stock price, guys. Yesterday's stock price is historical information. The stock price 1 minute ago is historical information. If you are using the stock price as the information, you're looking at historical information. So that's question number one. Okay. We're looking at historical price information. Second question. And this is the harder one. Okay. Is that information reflected in the price? Has the price reacted to the information? So the true question is it reflected in the price? What do you think?
I don't think so.
Why are you saying that? Tricky, tricky. Why?
Because
What's
just
make
a belief, like we believe it's gonna.
finish that sentence? You believe what? You're right, by the way. It's hard to see. It's hard to see, but you're right.
I'm sorry, my internet. We just believe in that is positive returns, but there is no data to prove it, I guess.
It's more like you have to think if you are using the information and you believe that this information can be used to predict the price, then that information is not reflected in the price. Anytime, here's when it's not super obvious, like this was super obvious, right? When it's not super obvious, guys, think about it this way. If the person in the story is using that information to make their decision, then it's not reflected in the price. I'm going to say that again, okay? If you are using the information to make your decision, the information is not reflected in the price, meaning there's a violation here. If you are using the information to make your decision, there's a violation. And so here, the info is not reflected. And so there's a violation. And then this is where you decide. And this is where it's okay to associate a type of information with a particular level. So historical, you should be assigning that, you should be associating that with weak form. So this is a violation of the weak form of the efficient market hypothesis. And then the last little dot you need to connect is what happens if you fail grade one? What happens if you cannot pass weak form or you violate weak form? What am I getting at? Go back and check your notes. What did we write? If we violate weak form,
We're violating the rest.
correct. Okay, guys. A violation of weak form is also a violation of semi-strong and strong. So this is what I was saying. Like if you forget, when you violate one, you automatically violate the ones above it. So the best answer here is actually E. This is a violation of all forms because they all say that historical information is reflected in the price. All three of the levels, if you look carefully at the rules, all three of them say that historical information is reflected in the price. So here you have historical information not reflected in the price. So you are violating all three of them. do one more. And this is again more of like a definition style question, I guess. Which of the following statements is true in a semi-strong, efficient market? I'm going to give you guys a second to read each one. Which is true in a semi-strong market? What do you guys think? Okay. Um, so Lara says C. The rest of you guys say nothing. Let's run through it. Okay, strong form. Remember that what that means. It means that historical price information is reflected in the price. It also means public information is reflected in the price. So these two are reflected. Private, not. So technical analysis can yield abnormal returns. No, because historical information is reflected in the price. One thing you guys want to connect with is when I say something is reflected in the price, and this might feel counterintuitive, but it is what it is. If something is reflected in the price, then it does not give you an advantage. It cannot be used to your advantage. I'll say it again. When something is reflected in the price, it cannot give you an advantage. And so here, because historical information is reflected in the price, it cannot be used to earn abnormal return. So A is out. B, fundamental analysis can be used. Nope, same thing, because fundamental analysis is what we call the use of public information. So for the same reason that A is wrong, B is wrong. Insider trading, aha, now that's private information. This can be used to earn abnormal returns because it's not reflected in the price. And then D is wrong. Okay. I'll say it one last time, then we're done with this chapter, okay? When something is reflected in the price, it does not give you an advantage. Sorry, when something is reflected in the price, it does not give you an advantage. Right? You cannot use it to earn abnormal returns.